So when it comes to comparison between India and China, so almost here and there till 1978, our economy and Chinese economy is here and there same. After 1978, things have changed dramatically with China particularly. They have boosted their manufacturing that has favored much. But in India, when it comes to India, 1991, I guess, liberalization has started. But still, I believe you are not up to the mark. So what are the necessary changes to be made by the government to pick up in terms of growth?
See, I don't think we can compare China and India directly
Okay.
because the whole political system is different. There, it's top down and one decision from the top, and everything has to get implemented.
Okay.
India, of course, we have a democracy and we have our own way of doing things. So, I don't think we can generate 10% GDP growth rate for 20 years like China has done, right? But I think we should definitely aim for 7 to 8% consistently for the next 20 years. That is certainly doable.
Okay.
I think what we have done in services has been excellent.
Okay.
And sector after sector, we have seen that if you let the private sector do its thing, we are able to be globally competitive,
Okay.
right? There was no IT services in 1990,
Yes.
right? We barely started in the late 80s and early 90s. But because of little bit of government support, of course, there was tax incentives and, the SEZ policy, etc. came in. But it was mostly lack of interference by the government.
Okay.
And look what we have done.
Okay.
Right? We are the largest in IT services exports in the world. Right? And even as we speak, a lot of the global competency centers, etc., are coming to India in a big way. So that completely left to the private sector, we have flourished. Similarly, in the 70s and 80s, we barely had any pharmaceutical industry, right? And again, because of little bit of government support, but mostly because of the private sector, today we are the largest pharmaceuticals and formulations producers in the world. We are not backward integrated in probably in the bulk chemicals and the API, some intermediates, where we are still dependent on China. But if you look at the formulations and chemistry process, we are absolutely number one in the world, largest supplier. So same thing happened in the 90s, in the 80s and 90s for the auto ancillaries.
Okay.
Right?
Okay.
When the Japanese motorcycles came into the country and Maruti came in for the first time, they developed the private sector ecosystem of suppliers.
Yes.
And now we are one of the large exporters of auto ancillaries also.
yes.
We are exporting full vehicles also, but auto ancillary we are very large suppliers.
Yes.
So I think if you create an environment where the private sector is allowed to do its thing, we are doing well.
Okay.
Right?
Okay.
I think the bigger problem happens where there is a requirement of either a lot of land and where there are labor intensive operations. There I think we need to simplify a lot in terms of the labor laws, the reporting systems, the compliance, etc. I'm not saying you should be unfair to labor like China is probably, where they keep artificially wages low and there's a lot of loose kind of but point is that we are, I think, on the other extreme where there is just too much burden of compliance, especially for smaller units.
Okay.
Right? So for small enterprises, for medium-sized enterprises, there has to be a lot more simplification. And I think ground level corruption is also a big problem. I'm not talking about high level corruption, but it is the ground level corruption which really is a pain and really disincentivizes the smaller enterprises. So I think encouraging smaller businesses, I think, is something that we need to do. Simplification of processes, ease of doing business, so to say, and land acquisition.
Okay. So based on your discussion, so which sectors or themes that you are focusing more, and where do you find potential risk or overvaluation?
I think in general, India is a very diversified market, right? But broadly, because of the initial discussion that we had, that I think the domestic economy is in a far better place than the global economy, right? So we are focusing more on domestic sectors in the portfolio.
Okay.
Right? And domestic sectors means not only consumer discretionary, industrials, but also financials, right? Because without banking growth, you can't have GDP growth. So that's the broad theme that we are following. But if I look at the structural themes that I would have in the portfolio, and which is something that we have stated from the beginning, it is basically three main broad classifications that I would say. First is consumption, premium consumption, and financial savings. So these are both linked to demographics.
Okay.
Right? Income levels are rising.
Yes.
And there's a migration of people upward to higher income categories. So from lower to lower middle to middle, middle to higher middle to affluent.
Yes.
So the migration of income levels creates a situation where premium products growth rate is higher.
Okay.
Okay. So everything which is premium in nature in terms of consumption is growing at a faster rate. Right. For example, soaps and detergents may not grow at a high rate because they are already saturated. It's a saturated category. But the next discretionary is things like, say, alcohol,
Okay.
right? Watches, jewelry, hotels, airlines. These are the next level of consumption, next level of luxury or consumption. So premium items.
Okay.
Within bikes, if you see, the low-end bikes growth rate is lower, but the high-end bikes growth rate is higher.
Okay.
Within cars, the cheap cars are growing slower, but the SUVs are growing faster.
Yes.
Within real estate, the higher ticket flats growth rate is higher than the lower end consumption. So everything which is premium in nature will grow faster as the income level demographics changes.
Okay.
So that is one big theme. Again, same link to demographics is the financialization of savings.
Okay.
As again income levels grow, the savings pool is growing faster than the economy.
Okay.
Right? So everything which caters to that savings pool growth is going to go faster.
Yes.
Now, whether it's insurance or asset management or wealth management or broking, capital markets, the whole bunch of subsectors which are linked to financial savings will grow faster. Of course, financials also include lending, but lending is a normal business, a mature business. The non-lenders probably will grow faster on a structural basis.
Okay. Okay.
Right? So that's one big theme linked to demographics, to consumption and savings.
Okay.
Second is physical asset creation, which is what you allude to. What would make India grow?
Yeah.
I think, as I said, we need to target 8% growth, right? But my view is that without physical asset creation, we will not be able to grow it more than 5 to 6%. That extra 2% will have to come from physical asset creation.
Okay.
Right? Our fixed asset creation as a percentage of GDP is about 30%. China for the last 25, 30 years has been at 50%
Okay.
every year, right? So every year we are creating $1 trillion of physical assets, and China is creating $7 trillion of physical assets even today,
Okay.
because it's a bigger economy and percentage is also higher, right? So the point is everything linked to physical assets, whether it's manufacturing, factories, buildings, commercial buildings, real estate, residential real estate, infrastructure, all kind of infrastructure, roads, ports, airport, everything has to grow much faster,
Okay.
including subsectors like defense, railway, power, T&D, which anyway are doing well because of the government push. So the point is that all physical asset creation has to accelerate massively,
Okay.
right? And that's where we touch upon things like labor laws, land acquisition, all those things need to be removed. And third is, of course, the fact that India has done very well on the digital side. So we have this Jandan, Aadhaar, mobile trinity. On top of that, we have the layers like UPI, direct benefit transfer, your RuPay card. So lots of innovations in financials and digitization, India has leapfrogged
Okay.
the rest of the world. So there are companies which are using this infrastructure and growing at a much faster rate. So these are all the new age companies. Some of them, as you know, have gotten listed, but some of them will get listed. So there are dozens of companies, I think, which will come and get listed in this space.
Okay.
Companies which use technology and digitization for creating new businesses.
Okay.
So these are some of the broad themes that we are looking at in the portfolio.
Risk and overvaluation.
Overvaluation wise, I think market in general is fairly valued. So there are some pockets of overvaluation, but again, those are the pockets which we believe that these have a longer trajectory of growth.
Okay.
Okay, so for example, some people believe that some of the capital goods stocks or some of the defense stocks look expensive. But point is that I firmly believe that stocks which have a visibility of not only 2-3 years, but 10-20 years of growth will typically appear optically expensive.
Yeah. Okay.
So, but the point is that the markets are seeing the longer term growth prospects, and that's why you are seeing the current valuations looking higher on current earnings. If you look at earnings 10 years down the line, probably they may not look that expensive, right? Otherwise, I think financials in banks in general, NBFCs are fairly valued.
Okay.
Because they've underperformed for a period of 1.5 years. They're catching up. So I think there's good pockets of value there. Commodity stocks in India typically tend to quote lower, so they are appearing reasonable. But as I said, the higher growth stocks look optically expensive, but I don't think they're that expensive.
Okay. Okay. So, what's your take on IT?
IT services, I think the bigger IT companies, IT services companies are I would say boring. Okay, because we are talking about 5, 7, 10% kind of a growth
Yes,
rate.
yes.
That's not the kind of growth rate we expect from our portfolio companies. Typically, our thresholds are much higher. But there are certain mid-cap companies which we have in the portfolio where the management is still hungry, the promoters are still hungry for growth,
Okay.
which will grow faster.
Okay.
So within IT, it's a stock picking kind of a theme.
Okay.
But the top few IT companies are not that exciting.
So
frankly
most of the
speaking.
top IT companies are service oriented. So
They are all service oriented.
yeah. So the product development based IT might perform well.
We don't have any such company in the portfolio which relies predominantly on product development, I would say. Though there are a couple of mid-cap companies that we have had from time to time. But we are still talking about IT services. Within that, the mid-cap IT services companies, some of them
Okay.
have, as I said, their base is low and they have some unique strengths and skills which enable them to grow faster. So we will be looking at that.
So as an AMC, risk management is your core strength. So how do you suggest a retail investor, how should they manage their risk?
I think the biggest way to manage risk, the most significant, I would say tool that you have in your hands as an investor is your asset allocation policy,
Okay.
right? And you need to sit with yourself and your advisor to figure out both your assets and your liabilities.
Okay.
People probably look only at the asset side. They forget that there's a thing called liability, and liabilities are not immediate.
Yes.
They can be 1 year down the line, 3 years down the line, 20 years down the line, but they need to be planned in advance.
Okay.
Right? So for example, if you have a young kid and the college education needs to be paid after 17 years, then probably you want to allocate a portion of that corpus which will help you reach that amount that you are looking for. And if you're, for example, looking to send your kid abroad, it's a very expensive proposition, right? But probably equities in the 17-year kind of a scenario can make you enough wealth for that.
Yes.
But you need to start now,
Yes. Yes.
whether it's a lump sum or SIP. So for the longer term targets, you want to probably go into equities.
Okay.
For shorter term targets, you don't want to go into equities because there the volatility is higher. Suppose you have a event or a wedding coming up next year, you don't want to put that money into equities, right? So that kind of planning has to be done. Longer term, the longer the tenure that you have, the more risk you can take. The shorter the tenure that you have, the lesser risk you can take. Otherwise, risk is inherent. You can't avoid risk. It's a question of how do you mitigate that. And we have seen that in volatile asset classes, while on a day-to-day basis or a year or any basis, it can look very volatile. Markets can go up 25%, go down 25% in a given year. But if you look at 5 years, 10 years, 20 years, then the returns look quite stable.
Yeah. Yes. Okay. So you have FlexiCap and you are about to come up with the multi-cap also.
Correct.
And if I ask you to choose one for an investor, retail investor, which one will you choose and why?
So they are similar but different, I would say. The structural difference is that the benchmarks, while they are based on the NSE 500,
Yes.
there is a difference in the weightage that the benchmarks give to the different market caps. So NSE 500, which is the FlexiCap benchmark, has about 72% in large caps and about 28% in mid and small caps.
Okay.
The same stocks are there in the multi-cap benchmark, NSE 500 multi-cap benchmark, but there the exposure to large caps is restricted to 50%.
Okay.
Balance is 25 each in mid and small caps. So structurally, the multi-cap benchmark has higher exposure to mid and small caps. Okay. So that's the structural difference between the two products.
Okay.
Right? And of course, as per the SEBI and AMFI guidelines, we have to have in the portfolio minimum 25% large cap, minimum 25% mid cap, and minimum 25% small cap in the multi cap fund. Whereas in the flexi cap fund, you can have any amount of any market cap.
Yes.
So it's a full flexibility.
Yes.
So we compare it to, if you look at a thali, you can either have a buffet thali or you can have a fixed thali, set thali.
Yes.
Right? So a flexi cap fund is more like a buffet thali.
Okay.
Where there is too many choices, you go and pick and choose and try everything, and then add on to whatever you like and all. So it's I'd say open field.
Yes.
Where a multi cap is like a fixed thali, where you have to have a fixed amount of certain items, and then of course if you like something more, you can go and pick and add more to it.
Okay.
So it's like a buffet versus a fixed thali.
Okay.
Again, the difference is that in a multi cap fund, the discretion of the fund manager is reduced compared to a flexi cap fund.
Okay.
So your dependence on the fund manager is far higher on the flexi cap side, where he can do anything, 100% mid cap, 100% small cap, 100% large cap.
Yes.
Whereas here, the fund manager is restricted.
Yes.
So that's the investor's choice, whether he wants the fund manager to take the call of mid, small, large, or whether he wants a minimum fixed asset allocation. So that's the multi-cap side.
Okay. So I heard about the gorilla strategies in business, could be in marketing and XYZ, but I never heard about the gorilla investing strategies.
Correct.
Can you please explain?
Sure. So, first of all, let's understand what a gorilla means.